All right, so let's check out some of your homework questions in chapter 6. This is number 1. And on problem number 1, we're going to be looking at the concept of FOB shipping point versus FOB destination. And so in this problem, we've got the XO group. They sell merchandise to companies for significant milestones in life, such as getting married, moving in together, having a baby, etc. Indicate yes or no whether the following costs would be recorded in the inventory account for XO. So remember, the context of this problem is XO's financial records. So part A says transportation cost incurred by this XO group when it buys goods from suppliers. Notice they're buying the goods and it's from suppliers under FOB shipping point, and the answer is yes. It's the inventory it's their inventory once it is put into that truck or that boat or whatever, because it's at the actual point of shipping. So that is actually their inventory. Under part B, same thing. And this is when it delivers goods to customers. So this is from the sale. And this is under FOB destination. And under that case, it's going to be no, because remember, FOB destination, it's when it actually reaches the customer who's buying it. So in this case, they would not include that in their inventory. And same thing on part C, where you've got transportation costs incurred by the XO group's customers when they're selling goods under FOB shipping point. And again, the same thing there would be no. And then again, down below, you can see the explanations they're giving you. So again, part A is yes, shipping point means the purchaser is responsible. Part B, FOB destination means the seller is responsible for the transportation. Again, back to part B, since they were the seller, they would report the transportation costs, but rather than include the cost in inventory, they would report these transportation costs as a delivery expense. And then again, under the last one, again, they're the seller in this case. They're not responsible under FOB shipping point. Even if they were, they would be treating these as a selling cost, not an increase to inventory. So that's a little bit more in depth on question number 1. All right, let's check out number 2. And on this one, they are going to be using, again, the perpetual inventory system. They give all the transactions. You can kind of just do these in a sequential order. So we've got, this is the auto dealership where they bought vehicles at a cost of $608,000. You can see down below where they're going to be debiting inventory, crediting accounts payable. And then it says they returned 152,000 of these. So there where you'd be debiting accounts payable, crediting inventory for the 152. And then it says they sold 380 at a cash selling price of 685. So notice that's going to be debiting cash, crediting sales revenue for 685. And then of course the cost of these, that's the cost, has to go to debit to cost of goods sold, credit to inventory. So 3 and 4, these two actually would go together. And then it looks like one customer did return a vehicle which had been sold for 137. And it was put back into their inventory at a cost of 76,000. And then you can see down below, you got the 2 entries where you've got the return, debit, sales revenue, credit cash, and then there's the cost, you're putting it back into inventory. All right, so that would be question number 2. On question 3, you can see the answers, but on this one, I'm just gonna, my only comment on this one is to find any missing elements, you just have to go back and look at the formula. So just to remind you, your inventory formula, remember it's beginning inventory, you add your purchases, that gives you goods available. Then you would subtract out your ending inventory. And of course, that would then give you your cost of goods sold. So if you know this formula, and then if you know that you've got your sales minus your cost of goods sold equals gross profit, you can see how in this categories you've got gross profit as a heading. Sometimes that might be an unknown. Sometimes cost of goods sold could be an unknown. Any one of these items could be an unknown. But where the point is as long as you know the relationship between these two formulas, all you have to do in this whole problem is just plug the numbers in, and sometimes you'll have to add, and then sometimes you'll have to subtract to get the missing element. All right, so that's all I'm going to say on problem 3. Let's see, problem 4 is going to be they want you to figure out the total amount of revenue to be reported for the month. And of course, you've got a series of transactions where you have some sales. The first 3, in fact, are sales. And then you got some situations where you got some payments. So you have to take into consideration, is it a cash sale, which the first one is, or a credit sale? And if it's a credit sale, what's the discount terms? And you have to watch to see if they get within the discount, and you also have to see if there's any returns. So in this problem, you've got the total gross sales. There's 1,000, 5,000 plus 3,000 is 9. And Claudio, which would be in this case on the 15th, they pay by the 23rd, so that's within 10 days. So they get a discount of 3%. So we lose 150, but Otto didn't pay us till the 31st. So that 3,000 is going to be gross. They're not going to get any discount on that one. So the only discount is the 150. So the net revenue should be 88.50. All right, number 5. Again, they just want you to calculate your net sales. And again, just some comments on this one. You've got a sale, a cash sale. Then you've got to receive merchandise from a return, but in perfect condition. You've got another sale. This one's on account. Then you've got a collection. And then you've got a partial allowance where you have a reduction. So let me just show you down below how you would get that net sale number. So you'll notice you've got your 2 sales revenues. You've got a couple of allowances of 1,600 and 1,800. That's how you would deduct that to get your net sales. And then your cost of goods sold was the 152,070, and then you have to subtract out that 800. That was returned, and then of course there's another 9,000. That's your cost of goods sold. You can go back and see the numbers up above. And then of course that's how you get your gross profit, by subtracting out cost of goods sold. So your net sales minus your cost of goods sold would be your gross profit, and that's where they would arrive at these numbers. All right, so that's my comments on 5. Whoops, let me go back for just a minute. I think there's a couple more to do on this one. 6, I think this was a consecutive problem. They want you to do the gross profit percentage. So remember, on gross profit percentage, you have to take the gross profit divided by net sales. So 131,330 divided by 291,6 would give you that number. And it looks like, again, they got the calculation right here, again, right there. It's going to be right at 45%. And then the rest of them, they just want you to do the transactions. There's like 8 of them. So if I go back up, you got A through E, and you can kind of go back and kind of piece them together. But this is what, I'll just make a couple comments on them. So you can see on the first of them, these are some repeat problems where you got your cash sale, and then there's the cost of goods sold matched up with it. You've got another, in this case, a return or allowance. In this case, a debit to sales revenue, credit cash. And then notice in that case, they also reversed the original sale by debiting inventory, crediting cost of goods sold. Here's a credit sale. So you got the credit sale and the cost associated with that. Part D, this is just a collection of accounts receivable. And then there's the other allowance where you're just debiting sales revenue and crediting accounts receivable. And I think, and then one more. This one again would be on question 8. And then it just says they're considering a contract to sell merchandise to a campus organization for $15,000. The merchandise will cost them $12,000. Would this contract increase or decrease their dollars of gross profit and its gross profit percentage? Tip: the impact on gross profit dollars may differ from the impact on gross profit percentage. And let me show you this calculation down below. Those, typically they'll show you how they got the number. You can see how it's actually going to increase the gross profit, but it will decrease the gross profit percentage as calculated below. So you can see how it's changing. That it might be increasing, but relatively speaking, the total percentage is actually going to go down. And they explain that the gross profit percentage decreases because the gross profit percentage on the contract, which is 20%, is actually less than the gross profit percentage earned without the contract. So it's actually, you're adding in, if you're talking about kind of like a weighted number, you're actually mixing in a lower percentage product, which overall will decrease the gross profit percentage. So that's where they want you to plug these numbers in up here. All right, and I think that was it. That was what, question 9 or question 8. And then let's look at the final 2. And again, on this one, they want you to do a multi-step income statement. So they give you all your accounts, and then you just have to plug the correct titles in. And move this down. So here's part 1. Notice you got sales revenue, cost of goods sold, gross profit. There's your other expenses. You get income from operations. There's an interest expense, and then an income tax expense. You want to put those on separate line items to get your net income, 22,400. So this is a good practice problem to make sure you can do that. And then they want the gross profit percentage, which again, we've done that a few times at this point, which is your gross profit divided by your sales. You get about 41.3%. And I believe on this one, that is it. So that's my final comments on your chapter 6 homework.